From the Fed's latest rate cut to surprising trends in equities and the evolving bond landscape, investors may be scratching their heads. Curious why Treasury yields can rise even when the Fed is cutting rates? Wondering what methods exist to potentially hedge your exposure as the year winds down? But we're going to talk about that and a whole lot more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us today. Simeon Hyman is here in the studio with me. He is the global investment strategist at ProShares. Simeon, nice to have you here.
Thanks for having me.
Yeah, a lot to get to because we're coming off of a recent Fed meeting where they cut rates again, 25 basis points, which is widely expected. We're going to get into equities and bonds in a moment. Let's stay with the Fed, though. It was a really interesting meeting, and on top of that, it was an interesting press conference with Fed Chair Jay Powell, because he kind of made it sound like they're thinking about possibly not cutting in December, depending on what they see. And plus, they're not getting jobs data because of the shutdown. So there's a lot that the Fed is having to kind of ponder. What are your thoughts on the Fed?
In the current lingo, there's a lot to unpack.
Okay, very good.
Let's start with what I call the logic of 2, 3, 4. If inflation gets down to 2%, Fed funds should be 3 and the 10-year Treasury should be 4. This is why we call this one of the last, if not the last or next to last, of the easy Fed cuts, because inflation is not at 2, it's at 3.
Right.
So therefore, a kind of neutral Fed funds rate is somewhere close to 4. Hence, this was an easy one, but to maybe one more is still somewhat easy. But to get really past that, you really need to have meaningful progress to that 2% inflation for the Fed to go further than maybe one more 25 basis point cut.
Right. Do you think they're going to go again in December? Our call here at UBS in the Chief Investment Office is 75 to 100 total from September through next spring. What are your thoughts?
The December one isn't going to be that hard.
Okay.
I think that's where it really gets hard after that. But I think the important thing to remember is even when the Fed cuts, that doesn't mean longer-term rates go down too. We just saw this when the Fed cut 25 basis points. The 10-year yield went up 10 bips.
Right.
But if you want even more evidence of that, last year when the Fed cut 100, the 10-year went up 100. Now, folks should keep in mind that that's the way the world often used to work. But we forgot that the world worked that way because of quantitative easing, because that was the extra tool that Ben Bernanke came up with to push down longer-term rates coincident with cuts.
Right. I mean, it seems like the bond market was really reacting to every single word that Powell uttered. If you look at the way, they were like, is he hawkish? Is he dovish? It's hard to tell, especially that they're now saying they're going to start unwinding QT.
Because it's the rule of 2, 3, 4.
Right.
4, a 4% 10-year already prices in ultimately getting to 2% inflation. And if the hawkish cut was sort of saying it's going to be hard to get to 2, well, then there's a little bit of pressure for the long end to sell off and maybe rates to drift up even a little bit higher than 4 and change.
Right. And the yield curve seems to be steepening a little bit as we sit here right now because of what you're talking about. Interesting. I kind of like the rule of 2, 3, 4. It's interesting to see what real rates are and what the Fed is looking at. Obviously, that 3% inflation that we're sitting at about right now, that's something the Fed is paying close attention to.
Still a pretty darn good soft landing.
Compared to where we were.
Compared to where we were. And we're doing that with a pretty healthy economy.
Right. Exactly. All right. So let's go over to equities. It's almost like you can't stop talking about what's happening in the equity markets. 2 years in a row, 2023 and 4, we were up 24% or so on the S&P 500. This year, the S&P is continuing its rally up about 16%. The NASDAQ, because of a lot of the AI trade, is up about 24% as we sit here. Talk about this rally and talk about where you see it in context of sort of the historical S&P and NASDAQ equity rallies.
In the context of history, both in magnitude and duration, we wrote last summer we were about halfway through the historical average bull market, both in price and return. So maybe we're a little bit past halfway, but it's still earlier than people think. But I do think it's important to keep in mind what can keep this going. It's not going to be the Fed necessarily, because we just talked about the 10-year Treasury already in a landing place reflecting 2% inflation. If that 10-year yield is stable, that's the guy that impacts PE multiples. So if that's stable, don't expect a tailwind from the Fed. And also, don't expect a tailwind from things that are cheap. Everybody says, well, this thing is at half the PE of the S&P, or this thing. Well, yeah, that's because the S&P is expensive. If you look at small cap stocks versus their history, the price to book is the same as it was 10 years ago. Half the price of the S&P, but the same as it was 10 years ago. So it's a little rough to just say, well, it will appreciate up to the S&P.
Yeah.
The answer has to be earnings, but the darn good news is earnings are looking really, really good.
They are.
We're about 2/3 of the way through Q3 season. S&P 500 earnings are up 10%. By the way, mid-cap earnings are up 11%. And I want to be careful about S&P because, small caps, because there's 2,000 companies, only 600 or 700 reported. I'll just say it looks really good too. So if there's a broadening, the broadening may very well come from earnings.
Yeah. It's a fascinating picture to look at it because the fundamentals are there. And even the guidance for a lot of the companies that we're hearing from is looking pretty strong as we go into Q1 and full year 2026 earnings.
Yeah, the guidance looks good, but also aside from the earnings, it's the cash flow and particularly the balance sheet strength. I know we're talking about cockroaches and things in private credit. We can't see exactly what's there. Here's what we can see in the public markets. Net debt to EBITDA, the classic measure of leverage for the S&P 500, is 1.5 times. That is all-time lows. That supports higher multiples.
Right. Thanks, Amin. Good stuff. It is a fantastic story, and I like the charts that we had up there talking about that we've seen really strong bull markets historically. So we're like you said, we're just about halfway past the halfway mark there. So maybe still room to grow. We have here at CIO, an attractive view on equities as we speak because of our views similar to yours. I want to talk about the bond market because it does look a little tricky. We kind of dipped into it a little bit, looking at treasuries as the benchmark, obviously looking at a steepening curve. What risks do you see right now when it comes to bonds?
Well, there's risk on both sides.
Yeah.
So there's salary cuts, if you will,
Right.
on the money market side, because each of these cuts reduces the level of income that you're getting from short-dated paper and money markets. But we also said that on the long end, you can get a little bit of a sell-off. We just had it, just a smidgen. We're not talking about catastrophe, but you could lose a couple hundred basis points of price if you're on the long end of the curve, and that's a challenge for a fixed income investor. And look, even if you do the math, folks need more income than they can get from fixed income. A 60-40 portfolio, I got 40, I got 3.5%. Okay, I don't think I can live on 1 to 2% income. And so we've been focused on opportunities where folks can generate some income from the equity side that we're a little bit more constructive on.
Right. Yeah, and that 60-40 traditional split is kind of moving to the sidelines a little bit. We like going into private credit and equity, adding some of that exposure to a portfolio, especially as we're seeing interest rates come down a little bit from where they were, 2 years ago when you were even looking at muni bonds with 7.5%. So, you're not getting as much, but we still think you got to put that cash to work. There's still time in the market right now. You've got to get in there.
Income that is not correlated to interest rate risk. And there's a classic strategy here. It's called a covered call strategy, where you own your stocks, but you sell options. You sell away the upside in exchange for income. Now, the problem there is that historically you do that on a monthly basis. You sell an option 1 month from now, and the trade-off has just been too stark. You sell off too much of the upside, and then you're left with kind of a disappointing equity market return. But there's been an important innovation in the space. The last few years, daily options have been available on the major indices in the U.S., and that has allowed folks to execute covered call strategies on a daily basis instead of a monthly. There are indices on this, the S&P 500 Daily Covered Call Index. Cool thing about it, you get the income, but you also get equity participation. And you can see it starkly as we rebounded out of Liberation Day, that 1-week pullback.
Right.
Most of the old school covered call strategies left in the dust, but daily approaches really participated and delivered the income that folks need.
Yeah, and it gives you good exposure to the equity market through that strategy.
Well, that's the other thing that's nice about it too, is because a daily approach behaves like it's underlying, you could follow the S&P 500 daily covered call index. You could also follow the NASDAQ flavor, and you're going to get NASDAQ-like performance. The old school strategies, they sort of eviscerate the performance. It doesn't matter what you were writing calls on, whether it's Malaysian equities, Chinese equities, Brazilian equities, you weren't getting it anyway.
Right.
So you can use a daily approach to not only participate, but also to have diversified equity income.
Excellent, Simeon. Thank you. Before we wrap up, just let's go back to equities for a second, because, I think there are some folks out there, and we hear from our advisors and some of their clients are still kind of nervous about equities at these levels right now. How do you put those nerves to rest? Just give them sort of the 30-second takeaway on that.
The shutdown is a real risk. Prices are admittedly a little high. There are risks out there. We know folks, they don't want to realize capital gains. They don't want to just sell out of their stocks. There are tools out there to hedge. Inverse ETFs can play an important role in the portfolio, allowing you to not realize those gains, but also to protect the portfolio for whatever horizon you see some risk.
Excellent. Simeon Hyman, always a pleasure. Thanks for coming by.
Thanks for having me.
Good to see you. Simeon Hyman again from ProShares. And thank you all for joining us. For more information on anything coming out from our great partners like ProShares and our own Chief Investment Office, visit our Insights website at ubs.com/views. Plus, make sure to follow UBS on social media. We're on LinkedIn and Facebook. Plus, Instagram, we've got our own dedicated channel there at UBS Trending. Give us a follow and go take a look at all that studio's content that's there. And as always, if you have any questions about what Simeon and I spoke about today, make sure that you are chatting with your financial advisor. Until next time, I'm Anthony Pastori. We wish you a great rest of your day. And remember to keep your eyes on what's trending, everybody. We will see you soon. Thanks.